Good morning, ladies and gentlemen. Governor of the Central Bank of Sri Lanka, Dr. Nandalal Veerasinghe, Secretary to the Treasury and senior government officials, members of the Governing Board, the Monetary Policy Board, board-appointed committees, and the Stakeholder Engagement Committee of the Central Bank of Sri Lanka, Senior Deputy Governor, Deputy Governors, Assistant Governors, and senior officials of the Central Bank of Sri Lanka, representatives of multilateral organizations, distinguished invitees, ladies and gentlemen. A very good morning to you all, and my warmest wishes for a successful and fulfilling New Year 2026. It is both an honor and a pleasure to welcome you to this flagship annual event of the Central Bank of Sri Lanka, held at the beginning of each year, where we formally unveil the Central Bank's policy agenda for 2026 and beyond. This policy agenda outlines policy measures focused on reinforcing price stability and safeguarding financial system stability in the period ahead. My name is Naveen Pereira, and I'm delighted to guide you through this morning's proceedings. Ladies and gentlemen, as you are all aware, Sri Lanka's economic journey has been both challenging and transformative, one that required difficult decisions, institutional resolve, and sustained commitment. If you recall, in 2022 and 2023, the national focus was on implementing critical corrective measures to address deep-seated imbalances, restore macroeconomic discipline, and most importantly, place the economy back on a credible path. In 2024, policy efforts were directed towards restoring stability as confidence gradually returned and the foundations of the economy were strengthened. Last year, the year 2025, marked a phase of consolidation, during which buffers were deliberately rebuilt, resilience was enhanced, and hard-won stability was preserved. And most importantly, it was a year that also coincided with the Central Bank of Sri Lanka marking its 75th anniversary, reflecting 7.5 decades of institutional service, policy stewardship, and commitment to economic stability. This year, 2026, represents a transition from consolidation to performance, a period focused on improving outcomes, deepening reforms, and maximizing the benefits of stability for the broad economy while carefully preserving the gains achieved thus far. So it is within this context that today's policy agenda for 2026 and beyond assumes particular significance. This policy agenda is the product of careful deliberation, rigorous analysis, and close engagement with key stakeholders across the economy. It reflects shared commitment to maintaining price stability and securing financial system stability, thereby guiding Sri Lanka towards sustainable and inclusive growth, shaped through extensive discussions at the Central Bank's decision-making boards, namely the Governing Board and the Monetary Policy Board, as well as valuable insights we've received from external stakeholders, many of whom are present here today. So before we proceed to the main event of the day, I would like to inform you that today's event is being live-streamed across all official social media channels of the Central Bank, and we encourage you to share this information with your colleagues so that they too will be able to listen to the Governor's statement live. Also, if I may ask, to ensure a smooth and uninterrupted experience for everyone, we kindly request that mobile phones be either switched off or placed on silent mode during the proceedings. So with that, ladies and gentlemen, without further ado, it is my distinct privilege to invite the Governor of the Central Bank of Sri Lanka, Dr. Nandalal Veerasinghe, to present the Central Bank's policy agenda for 2026 and beyond. Over to you, sir.
Thank you, Naveen. Secretary to the Treasury and senior government officials, members of the Governing Board, Monetary Policy Board, appointed committees, and Stakeholder Engagement Committee of the Central Bank Sri Lanka, Senior Deputy Governor, Deputy Governors, Assistant Governors, and senior officials of the Central Bank of Sri Lanka, representatives of the international organizations, distinguished invitees, ladies and gentlemen. As we begin 2026, I extend my warmest wishes for a prosperous new year that calls for courage to rebuild with renewed resilience and unity in advancing reforms. In 2025, the last year, Sri Lanka made notable strides in strengthening macroeconomic stability while advancing policy reforms. Building on the stability regained, real economic activity sustains its momentum during this year, as we witnessed in terms of economic growth. This was achieved amidst several shocks and uncertainties. Firstly, trade policy uncertainties that we witnessed at the early part of the year, financial market volatilities, and geopolitical tensions dented the global economic outlook, thereby affecting domestic sentiments during part of 2025. At the same time, the country had to grapple with growing realities of climate vulnerabilities, a fact starkly underscored by the cyclone Ditra that caused severe devastation in late 2025 in terms of loss of lives and damages to property while disrupting the livelihoods of many. Our thoughts are with all those impacted by the disaster. These shocks can transmit rapidly through our economy and test its resilience. This is why building resilience is not a choice but a necessity in this kind of situation. At the core of resilience lies a macroeconomic stability. The resilience fostered by stability enables an economy to effectively absorb shocks, adapt evolving conditions, and recover with confidence. With this firmly in mind, the central bank will remain committed to fulfilling its mandate of maintaining the first domestic price stability and safeguarding financial system stability. This will provide a platform for the economy to confront future challenges with great confidence, thereby achieving sustained growth and prosperity for people in Sri Lanka. Against this background, let me now highlight some of the key developments very briefly in 2025 and outline our priorities and plans for the period ahead, 2026, this year and beyond. Please note that this agenda is not a static blueprint. Rather, it's designed to remain flexible and responsive to evolving macroeconomic conditions and any uncertainties evolving, enabling us to better fulfill our mandate of maintaining price stability and financial system stability while supporting the economy's continued progress. So, first part, our key mandate on price stability. In 2025, the central bank further eased its accommodative monetary policy stance with a view to supporting a sustainable recovery in the economy in an environment of subdued inflation pressures. Accordingly, we induced an overall reduction in market interest rates. Credit to the private sector, especially last year, expanded notably during this period amidst a contraction in credit to the public sector. So there's an expansion in private sector and there's contraction in the public sector as a result of better performance by the public sector institutions. The expansion of private sector credit has been broad-based across key economic sectors, including a notable increase in lending to the household sector in line with strengthening demand conditions. This credit expansion supported sustaining growth momentum in 2025. That's one of the key reasons we are seeing the positive close to 5% growth last year. In operating under flexible inflation targeting framework, which is our monetary policy framework, the central bank has always recognized that transparency, credibility, and accountability are essential to effectively anchor inflation expectations. That's a key part of the monetary policy. The agreement reached with the government in 2023 on inflation target of 5%, along with the provisions of the Central Bank Act, ensures that central bank remains accountable for achieving the inflation target. The deflationary conditions and the subsequent period of low inflation resulted in inflation remaining below the target by more than the agreed margin for the second quarter of 2024. Accordingly, the central bank continued to submit reports on the deviation of headline inflation from the inflation target to the Parliament through the Minister of Finance. By making these reports available to the public, the central bank has further strengthened its transparency and accountability to both the Parliament and the general public, thereby reinforcing credibility of and anchoring inflation expectations. According to the predictions prior to the cyclone Ditra, inflation is expected to continue to gradually rise in 2026, reaching the target of our 5% by the second half of the year. There are both upside and downside risks to inflation rising from the devastation caused by the cyclone. The possible impact of Cyclone Ditra and possible policy responses will be incorporated in upcoming forecasts in our monetary policy review cycles. Destruction of supply chains and infrastructure could hurt growth prospects, while reconstruction activities and related spending would be growth positive. There are both downsides and upside risks to the growth for this year. Continuing the growth momentum reported during the last 2 years, economy is expected to grow by around 4 to 5% in 2026, according to our estimate for this year. But there could be both downside risks and upside risks, depending on the phase of implementation of especially important structural reforms, as well as implementation of especially this year additional expenditure by the government on the rebuilding and reconstruction efforts. That could be growth positive. Any delays could be there could be downside risk as well. And made notable progress in building buffers across the fiscal, external, and monetary and financial sectors of the economy. We believe that the economy possesses a greater capacity compared to that we had in the past, greater capacity to bounce back from this devastation much faster than in the past. So that's an important part of the building buffers for us to meet this kind of shocks. Like many other parts of the world, the frequency of extreme weather events in Sri Lanka has increased in recent years. The central bank remains vigilant about any possible supply-side shocks that can affect the general price level and inflation expectations due to the impact of such shocks. As you are aware, central banks have limited capacity to respond to supply-side shocks in managing inflation. Going forward, the other measures to smooth the impact of such supply-side shocks should also be prioritized at national level. In this context, while appreciating the ongoing efforts to restore normalcy with the support of the national and international stakeholders, we reiterate the urgent need for prioritizing the country's disaster preparedness and long-term resilience building for us to have more resilience. During 2025, Sri Lanka's external sector faced significant challenges amidst elevated global uncertainties rising from shifts in global trade policies and heightened geopolitical tensions that we experienced last year. Domestically, these pressures were compounded mainly by the import of vehicles, more than what we expected, largely reflecting the release of pent-up demand at a scale much higher than expected. This was further fueled by the forced speculation on the reinstatement of restrictions. That's part of the reason why we saw some pent-up demand. These developments exerted some pressure on the foreign exchange liquidity and the currency. Nevertheless, the external current account of the balance of payment is estimated to have registered surplus for the third consecutive year in 2025. As a result, the market-determined exchange rate remained less volatile and reported a gradual depreciation during the year. Despite facing challenging conditions, such as meeting obligations for servicing external debt, especially after the restructuring debt of the government, without corresponding inflows and increased demand for vehicle imports, gross official reserves, which hovered around $6 to 6.3 billion during the most part of the year, surpassed $6.8 billion by end 2025. So this represents the highest level of reserves recorded since the crisis and exceeds the IMF latest projection for end 2025, which is gross reserve of 6.55 billion. So if you look at the IMF projections for end 2025 to 6.55 billion, we have been able to achieve 6.8 billion, which is much higher than, even without this, with the delay of the disbursement of IMF, if a tranche of 350 billion, instead we got RFI of 200 billion. The build-up of resources was largely supported by $2 billion in net foreign exchange. That's mainly coming from central bank purchases from the market of 2 billion last year on value date basis from the domestic foreign exchange market, along with some proceeds from multilateral agencies, especially from the ADB and the IMF. Substantial net foreign exchange purchases in 2025 followed net purchases made by central bank from the domestic foreign exchange market in the previous 2 years as well. It's a record purchase of foreign exchange, 2023 and 2024, amounting to $1.7 billion and $2.8 billion respectively in those 2 years. The central bank remains committed to building reserves through market purchases in order to meet the country's reserve adequacy requirements while allowing exchange rate flexibility. I would like to note that the government's continued commitment to fiscal consolidation is highly commendable. Sustaining fiscal discipline also supports the central bank policy objectives of maintaining price stability and safeguarding financial stability. This is for after several decades, government has been able to outperform the targets that they have announced at the beginning of the year. So let me now briefly discuss the policies to be implemented in 2026, focusing on enhancing the formulation of execution of monetary policy, along with our ongoing efforts to improve the transparency and predictability of our policy actions, especially in monetary policy part first. Monetary policy decision making will continue to be data driven, and improvements to modeling, especially the capacity to forecast and predict using modeling, will continue to capture post-crisis economic dynamics more accurately. The central bank is committed to continuously improving data coverage, granularity, and analysis to enhance forward-looking and data-driven monetary policy decision-making. The models used in policy deliberations will be continuously evaluated and improved to better reflect the structural changes taking place in the economy and to suit the evolving economic conditions. The ongoing efforts to strengthen the modeling and forecasting capacity, we will continue to do that, while building supplementary models to support policy making. So that number of policy technical work going on here. In a data-driven policy formulation process, having access to a wide range of accurate and timely data is essential for effective policy analysis. While data collection from traditional sources provides information necessary for policy analysis, relying solely on these sources is insufficient for keeping up with the rapidly changing economic conditions and for developing agile policy responses to economic shocks. As a result, economic policymakers are increasingly embracing high-frequency data at granular levels for more insights. In this regard, we central bank will continue to enhance real-time economic surveillance through the collection of granular high-frequency data and sentiment supported by novel technologies to strengthen monetary policy deliberations. While the central bank highly appreciates the support of the data providers thus far, success of this process requires continued and close engagement of relevant institutions going forward. This is beneficial both ways. We can share information with you based on the data analysis, and also we can benefit in our policy making as well, and also for the other stakeholders. As required by law, there will be a review of the agreement. This is another important part of the monetary policy. There will be a review of the agreement with the government regarding inflation target this year. In this regard, we would like to thank stakeholders who have already expressed various views on target setting. Central Bank will conduct thorough review of macroeconomic developments and structural changes in the economy, followed by an analytical assessment of the target. Following this assessment, a consultation with relevant stakeholders is also planned. This is something that we did in 2023 also. Now we will continue to do that this time also to review the appropriate inflation target for Sri Lanka. I think last technical work we already published in a staff studies paper. That's for the more transparency, how we determine the inflation target for last 3 years. After this consultation, the agreement will be jointly reviewed by the central bank and the government. The review process aims to achieve many objectives, including enhancing the stakeholder awareness of the current flexible inflation target framework, explaining the reasoning behind setting the inflation target at a Swiss-wide level, and emphasizing the importance of allowing sufficient space to absorb potential domestic and global supply shocks following the experience of other economies and taking into consideration the stakeholder views. This is an important exercise that we had to do this year. The central bank's monetary policy communication, the important part is communication of monetary policy. The strategy will focus on accessibility and inclusivity in disseminating accurate information to ensure that our policy messages reach all segments of the public and are clearly understood. To achieve this, we will expand our communication strategy to maintain close engagement with stakeholders and a greater public understanding of monetary policy actions by the central bank. This is very important for people to understand with transparency the actions taken by central bank, especially in the monetary policy making process. Through this, we aim to support informed decision making by general public and build public trust. Today's gathering serves as a significant reflection of our steadfast commitment to this effect of national importance. That's why we are giving very important priority for this event in terms of communication strategy. The conduct of monetary policy was streamlined under single policy rate mechanism and operationalized through the overnight policy rate last year. During 2025, while the central bank managed domestic money market liquidity at appropriate levels, some upward deviation of short-term interest rates from OPR was observed in late 2025, largely reflecting asymmetry in liquidity distribution among market participants and the pickup in credit growth. So we hope that this will be addressed this year. Going forward, this transitory deviation is expected to be corrected as appropriate. Central bank stands ready to manage liquidity in line with the monetary policy stance to ensure the short-term interest rates, that is our target rate in terms of policy, remain aligned with the desired policy path, supporting the maintenance of inflation target, medium to long-term basis, around 5%. The central bank aims to strengthen its monetary policy implementation framework by introducing enhancement to the existing infrastructure of monetary operations. So that's also a continuous process. These improvements will be complemented by the adoption of international best practices to enhance market transparency and depth with overarching objective of facilitating market development in support of achieving the objectives of the central bank. The last year, we announced that the central bank would be reviewing and optimizing the statutory reserve ratio SRR framework. Accordingly, the SRR framework was reviewed in 2025 to further align with international best practices. This year, several modifications to the SRR framework will be implemented. Other part is the domestic financial market. As announced last year, the necessary studies to implement the benchmark spot exchange rate were carried out through the year 2025. It's other part of market development, especially in the financial market. Accordingly, a benchmark rate will be introduced this year, first time this year, in 2026 to foster a transparent financial market. This is also market development depth and the transparency of foreign exchange market activities. This benchmark rate is expected to guide market participants, help reduce volatility, and promote more competitive pricing on a given date, thereby enabling the introduction of more innovative products in the financial market that will help stability in the exchange rate as well. Also, with all now we had several import restrictions last several years. Now all import restrictions now being removed. The base year for the nominal effective exchange rate and also for the real effective exchange rate indices will be updated to better capture Sri Lanka's overall trade competitiveness. That is for information for the market and the other stakeholders to have understanding on the real effective exchange rate movements. That we will be rebasing that this year. The other part is the reserve management. That's key responsibility of the central bank. Central bank's reserve management will continue to be guided by three core principles, which is safety, liquidity, and return. This will ensure that the foreign reserves are managed prudently and effectively in accordance with some sound governance frameworks and international best practices. Meanwhile, with the improvements in foreign reserves, an investment tranche was established to enhance returns and capitalize on favorable market conditions. This was established last year with the building resource. Now these are additional tranche has been now established for medium to long-term investment of official resource. This marked the first such initiatives in 4 years, following a prolonged period during which resources remained low and were maintained solely to meet liquidity requirements and working capital requirements. Today, in keeping with this statutory requirement and as done in the past, we are happy to announce the monetary policy advance release calendar for 2026 is now displayed on the screen. There are 6 reviews that dates are now announced in advance, so that give much more predictability of monetary policy reviews and decisions going forward. Now let me turn to key developments in relation to financial system and the strategies that we will pursue to strengthen financial stability. That's key mandate, second mandate in the period, in this period. Financial system continued to show resilience in 2025, supported by strong macroeconomic fundamentals and the gradual easing of spillover effects of the crisis that we had in 2022. These conditions enable the rebuilding of capital buffers and reinforce overall financial system stability. As a whole, both the banking sector and finance companies, together that we coming under our regulation, recorded notable improvements driven by improved asset quality, enhanced operational efficiency, and strong profitability last year and also this year. Furthermore, liquidity and capital adequacy levels remain well above regulatory thresholds, further strengthening systemic resilience. Building on this stability, the finance system is well positioned to withstand potential future shocks and to sustain stability going forward. During 2025, Central Bank took several targeted measures to safeguard systemic stability. This included revising the criteria for designated domestically systematic important bank DSIBs. We have revised the framework, and we have now one more bank, and introducing updated loan-to-value ratios as a macroprudential measure during 2025. At the same time, analytical capabilities were strengthened, thereby improving interconnectedness and contagion analysis across the banking and finance company sectors under macroprudential surveillance. This allows us to assess risk more comprehensively in a forward-looking perspective across finance systems, financial sector, especially across all the sectors. Continuing these efforts, Central Bank is in the process of establishing coordinated data sharing arrangement between the Central Bank and other financial sector regulators. This will enable us to better understand interconnectedness and spillover risk across the financial system beyond the regulatory entities by the Central Bank. With the support of other regulators, we will also extend the scope of macroprudential surveillance to financial sector participants regulated by other authorities and develop appropriate prudential standards to strengthen systemic risk oversight across the broader finance sector. Strengthening collaboration between regulatory authorities is critical as these efforts are mutually beneficial and essential for safeguarding overall financial stability. In fact, this comes under the new Central Bank Act, which has given the authority, empowers Central Bank as a macroprudential authority for the broader financial sector. As we discussed earlier, climate-related vulnerabilities, also important one, have become increasingly evident, particularly following the cyclone Ditra, which disrupted multiple sectors of the economy, including the impact on the financial sector. Such weather extremes create high-risk exposure of financial sector given its interconnectedness with vulnerable sectors across the economy. This is why Central Bank also has a role to play here. In response to the cyclone impact, the Central Bank directed banks and financial institutions to provide immediate relief measures, including moratoria and targeted support for those affected. But beyond these short-term measures, recurring natural disasters remind us broader risk climate-related shocks pose to financial system stability. This also highlights the importance of building buffers during period of stability, especially in the financial institutions, enabling the financial system to withstand and absorb shocks which are likely to occur more frequently in the future. In this context, strengthening systemic risk oversight and enhancing the resilience of the banking sector through countercyclical capital buffers framework remains a key priority for 2026. So this year, we are going to bring in countercyclical capital buffers just to strengthen resilience of this banking sector. This is designed to mitigate cyclical risk by promoting the build-up of capital buffers during good times. It can then be drawn down in the time of stress. That's a very important instrument and tool that we need to build. That's one of the part of the building buffers to meet any external shocks. In line with national climate initiatives and to strengthen the resilience of the financial sector against climate-related risk, the Central Bank launched the Sustainable Finance Roadmap 2.0 in 2025. As you can remember, we had the similar event here. This year, the green finance taxonomy will be broadened to include social dimensions of sustainable finance. So we launched earlier the taxonomy that we will broaden that and include social dimensions also into the taxonomy this year, especially applicable to the financial sector. In respect of microprudential supervision of licensed banks, that's important mandate and function that central bank has. Supervision of licensed banks and finance companies. Central bank continue to implement prudential policy measures and regulatory initiatives aimed at strengthening the safety, soundness, and resilience of the financial sector. At the same time, we further enhance risk-based supervision and continuous surveillance frameworks to ensure timely identification and mitigation of emerging risks. Also, we are working on bringing more technology into the regulatory supervision in terms of some initiatives leading to SupTech. Going forward, continuous supervision will be further strengthened through a comprehensive review of the regulatory framework applicable to the banking sector, including loan classification standards and risk management requirements in alignment with the Basel core principles and international best practices. In parallel, the legal framework governing the non-bank financing sector is expected to be reviewed in 2026. That's one of the important reforms, especially when it comes to non-bank finance sector. Important reforms will happen this year, especially legal reforms. These reforms will be supported by ongoing efforts to strengthen institutional capacity and expand the use of data-driven supervisory tools for early risk identification, thereby further reinforcing the overall supervisory process. At the same time, the central bank will continue to support offshore banking activities through appropriate regulatory and supervisory oversight. That we hope that's including the offshore banking activities, especially in the port city area, that there will be much more active offshore banking activities happen this year. In addition, the central bank efforts to develop a more resilient financial sector will continue under the master plan for the consolidation of banks and finance companies. This is an important one for this year. Consolidation of both banks and finance companies. Accordingly, monitoring of finance companies was commenced based on the scores achieved by finance companies in terms of the revised framework for phase 2. I think we have already announced that to the stakeholders. These efforts will ensure long-term sustainability, enhance financial stability, improve efficiency, and strengthen risk management across the sector. Moreover, consolidation, both banking and non-bank sector, will enable banking and financial institutions to achieve the scale and the balance sheet strength necessary to support large-scale and complex investment and growth, which is imperative to enhance investment in the country. Furthermore, consolidation enables greater investment in technology, promotes financial inclusion, and positions institutions to engage in a healthy and sustainable competition. The crisis in 2022 underscored the critical importance of having a well-established and effective resolution framework for the financial sector. I can remember there was a few serious concerns on the stability of the financial sector back in 2022. In response to those concerns, the central bank made a significant progress during 2025 in strengthening the Sri Lanka's resolution framework with a strong focus on enhancing institutional readiness for any resolution. These initiatives are expected to be completed this year also in 2026 in line with international best practices, thereby supporting financial system stability and orderly resolution and distressed financial institutions that also provide much more stability, trust, and confidence on the financial system stability. The continued execution of compensation payment, this other part of the compensation through the Sri Lanka Deposit Insurance Scheme, that it has further strengthened public confidence in the financial safety net. With the support of the World Bank, for the enhancement to the Sri Lanka Deposit Insurance Scheme are envisaged. We had good support last year as well, including strengthening its fund base, reinforcing its role as a robust backstop within the broader financial safety net architecture, alongside efforts to build institutional capacity. Enhancing public awareness is important on the Sri Lanka Deposit Insurance Scheme. That would also be a key focus area in this year. Have more awareness on the deposit insurance scheme, especially for depositors of these institutions. Collectively, these measures will strengthen the resilience of the financial system and enhance its capacity to withstand future financial any shock or crisis. While the central bank supervisory focus has traditionally centered on microprudential oversight of financial institutions, growing concerns relating to other side, the consumer-centric issues also have necessitated a strong emphasis on market conduct and financial consumer protection. This is other part of the banks and finance sector. Accordingly, the regulations were further strengthened to promote fairness, transparency, and accountability in the pricing and delivery of financial services to the broader financial consumer sector. Supervisory oversight in relation to market conduct and financial consumer protection was further reinforced through the proactive management of consumer complaints and investigations into prohibited and unauthorized schemes. That's the other important one. We had a lot of awareness last year. Prohibited and unauthorized schemes, thereby contributing not only to consumer confidence, but also the integrity and stability of the financial system. These efforts are complemented by targeted public awareness initiatives, as you mentioned earlier, recognizing that awareness is a critical pillar in enhancing consumer understanding, financial products, and improving product protection outcomes, and also preventing public getting into all these unauthorized and scams. Going forward, the central bank will further enhance its supervisory processes to enable the early identification of consumer-related risks, addressing unfair market practices, and reinforce disclosure and transparency requirements for regulatory institutions. This is something that we are promoting this year, especially emphasis on more disclosure and transparency requirement by the regulated entities for their customers. In this regard, the mutual reinforcing relationship between financial stability and consumer confidence is underscored. This is why it's important for financial stability also, consumer confidence, as a strong financial consumer protection is essential for economic resilience and sustainable growth. Central Bank also calls for the continued cooperation of financial institutions to enable market conduct and financial consumer protection principles within their organizational culture and day-to-day operational practices. Last year, significant progress was made in enhancing the digitalization, efficiency, and accessibility of national payment system. That's one other mandate the central bank has. In this context, the central banks, together with National Payment Council and Industry Consultative and Monitoring Committee on Payment Settlement Systems, developed the National Payment System Roadmap for 2025 to 2027. This roadmap provides a clear strategic direction and well-defined targets for the industry to collectively progress towards a less cash, digitalized economy while promoting innovation and strengthening the safety and efficiency of the national payment system. Looking ahead for this year and beyond, the central bank will continue to prioritize its efforts to further improve the efficiency and effectiveness of Sri Lanka's payment systems, while safeguarding their safety and resilience. In support of these objectives, legal reforms relating to payment and settlement system, and this is important reform again this year, legal reforms in this area are expected to be undertaken in 2026. In parallel, Central Bank will also explore opportunities to link Sri Lanka's payment systems with international payment platforms, more thereby enhancing cross-border integration, efficiency, and accessibility for cross-border transactions with a more cost-effective manner. So let me now turn into other policies of the central bank. There are several other agency functions, a couple of. Moving into other policies and functions of the central bank, beyond our two core objectives we already talked about, central bank promotes financial inclusion and undertakes several agency functions on behalf of the government with the key focus on strengthening financial inclusion and literacy, enhancing foreign exchange management under the Foreign Exchange Act, and defending anti-money laundering, combating the finance of terrorism countering, AML CPF framework through regulatory improvements and coordination and stakeholder engagement. These other functions are, we have much broader stakeholder engagement and collaboration need to take place for us to achieve success in those other agency functions. Further on our focus on maintaining stability, Central Bank has enhanced its efforts. First part is on promoting financial inclusion. This reflects a broader recognition of the importance of fostering more inclusive and sustainable financial system. This is very important for us to have effective monetary policy and system stability. Financial systems should be much more inclusive than what we have today. In this context, Central Bank continued the implementation of Financial Literacy Roadmap of Sri Lanka, which was launched in 2024, supporting the development of advancing financial well-being of Sri Lankans. Phase 2 of the National Financial Inclusion Strategy, NFIS, is expected to be formulated this year which will focus on broadening financial inclusion across Sri Lanka. The new phase aims to expand access to quality financial services for underserved populations while strengthening financial consumer protection and integrating inclusive green finance. That's going beyond the inclusion, including going even through green finance, inclusive green finance, through much broader underserved populations. Ensuring the orderly and lawful flow foreign exchange, that is another agency function, Foreign Exchange Act. Flow foreign exchange for investment and other authorized purposes, Central Bank continues to carry out foreign exchange management on behalf of the government. In 2025, Central Bank expedited the gradual relaxation of capital flow measures imposed since 2022. We can remember this relaxation came back in 2022. Since then, we are in the process of gradually relaxing the restrictions. Also, while conducting continuous supervision and awareness programs to strengthen compliance with the regulatory framework. A comprehensive review of existing foreign exchange policy framework, which commenced in 2025, will continue in 2026 as well. That shows some revisions to Exchange Foreign Exchange Management Act that will continue this year to ensure that regulations remain in line with the evolving economic conditions and the financial needs of businesses in an economically sustainable manner. So, key priorities for 2026 include assessing policies related to investments in companies incorporated in Sri Lanka by non-resident investors, as well as the external commercial borrowings of resident companies. Those are two important areas that we are going to make some reforms this year. In parallel, supervisory and monitoring systems is still important. While relaxing and liberalizing, we need to have a strong supervisory monitoring system, which is expected to strengthen further through required reforms in law enforcement with a view to ensuring prudent foreign exchange management in the country, that is to prevent any kind of misuse of the regulations. Another important area, very important this year, especially the AML safety CPF framework. 2025, the Financial Intelligence Unit of Sri Lanka, FIU, strengthened the national AML CFT CPF framework, further with greater collaboration with its stakeholders. This is a collaborative effort by a large number of stakeholders. Key achievements during the year included improved mechanisms for monitoring stakeholder action plans, progress in amending core AML CFT CPF laws, increased analysis and dissemination of suspicious transaction reports, STRs, and targeted capacity building programs of all the other stakeholders to enhance institutional effectiveness, awareness, and national readiness for the third mutual evaluation. This is very important. Third mutual evaluation will take place this year, which will commence in 2026 and supposed to be completed by the end of the year. Sri Lanka's third mutual evaluation, the last two times we were grey-listed. Third mutual evaluation on its AML CFT CPF framework, coordinated by the Asia Pacific Group on Money Laundering, will be a major milestone in 2026 for Central Bank and other all key stakeholders. The successful outcome of the mutual evaluation will depend on demonstrating a high level of technical compliance with the 40 recommendations of the Financial Action Task Force, FATF, and effectiveness. One is technical compliance, second is effectiveness against 11 immediate outcomes. The mutual evaluation is a coordinated effort involving both public and private sectors, including key ministries such as the Minister of Finance, Minister of Defense, Minister of Foreign Affairs, Minister of Justice, and other key agencies such as the Attorney General's Department, Sri Lanka Police, and Sri Lanka Customs. I must appreciate the support collaborator. The continuous support is needed for us to successfully complete the mutual evaluation this year. The highest political will and commitment, effective interagency coordination, and close collaboration of relevant stakeholders will be vital in successfully facing the mutual evaluation. Our the FIU will mainly focus on coordinating the mutual evaluation by leading national preparedness, monitoring stakeholder action plans, they always shared action plans with all the other stakeholders, and facilitating submissions and engagement with the assessors and getting ready to meet the assessors in the period ahead. It is imperative that Sri Lanka approaches the mutual evaluation from a position of strength. At present, the country is well positioned to achieve a favorable outcome with all the efforts that we have so far taken. Nevertheless, it's important to recognize that any unfavorable outcome of mutual evaluation would have significant economic and reputational repercussions for Sri Lanka. If Sri Lanka's AML, CFT, CPF regime is found to have strategic deficiencies, Sri Lanka would be placed in the FATF's International Cooperation Review Group, SCRG group list of jurisdiction under increased monitoring, that putting on the which is called the grey list. Grey listing would result in increased scrutiny of cross-border financial transactions, higher compliance costs for all the institutions, delay in international payments, and reduced access in corresponding bank relations. That was very important that we don't go into that direction. It could also adversely affect foreign direct investments, capital inflows, export-oriented sectors, remittances flows, and overall economic growth, while increasing borrowing costs for both public and private sectors. Accordingly, reinforcing the national urgency to elevate the mutual evaluation preparations as a top-tier priority and strengthening stakeholder commitment and accountability would be critical to securing a successful mutual evaluation outcome. This is one of key priorities for this year for Central Bank, in addition to our main mandates and other functions that we talk about. Then there's another agency function that we have given by the EPF Act. Central Bank, as custodian of the Employee Provident Fund, the largest superannuation fund in Sri Lanka, will introduce major service and system upgrades to provide members with efficient service delivery and easy access to benefit across near 22 million member accounts in the period ahead. The journey towards a paperless environment, expanded digital contribution payments, and a unified one e-system will reduce delays, improve transparency, and speed up both pre-retirement and retirement payments. At the same time, the EPF will continue prudent investment and diversification to strengthen risk-adjusted returns while safeguarding the long-term security of members' retirement savings. Looking ahead, there's a debate going on. Though the Central Bank has no objection to transferring this function out of the Central Bank, as we did for PDMO, Public Debt Management, the government has decided to retain such assembly with the Central Bank until they make a policy decision to prepare a much stronger institution to take over this responsibility with the institutional strength. So we hope that we still will continue this operation. We will ensure that we provide a reasonable, fair and right return for all the members as custodian of the fund. Then on the other important function, coordination, is fiscal, monetary and financial policy coordination is very important. Effective coordination between the Central Bank and the government on fiscal, monetary and financial stability policies is essential to ensure coherent, credible and predictable macroeconomic policy framework benefiting all stakeholders. While fiscal policy decisions and measures can directly influence inflation dynamics and financial system soundness, close coordination within the mandate is critical for the Central Bank to achieve its objective of maintaining domestic price stability and safeguarding financial stability. Is also important for the other stakeholders to meet their objective as a strong coordination between monetary policy, fiscal policy and other policies. Meanwhile, since the Central Bank policies can also impact fiscal policy, improved coordination among fiscal, monetary and financial sector policies will be beneficial for both monetary and fiscal policy formulation and effective implementation. The Coordination Council, this is the instrument and framework that's embedded in the Act, in the law. The Coordination Council serves as a primary platform for such coordination, meeting regularly to assess macroeconomic and financial conditions, identify potential gaps, and agree on strategic responses to emerging risks. To complement this Coordination Council, there are other two mechanisms. One is the Financial Sector Crisis Management Committee, FCMC, that was established during the crisis period, and also the Financial Sector Oversight Committee on the Macroprudential Supervision, FSOC, which is coordination between other regulators. These three platforms mechanism provides structural platforms for the crisis preparedness, intelligence collaboration, and the strengthening of the resilience of the financial system. Then on the Central Bank accountability is other important part. Central Bank public accountability that should come with the independence under the new Act. Central Bank's public accountability and policy transparency are further reinforced through its regular engagement with the Parliament. This includes submission of statutory reports to the Parliament, discussing the Parliament Committee on the functions and operations of the Central Bank, the Central Bank's board members and senior management in attendance, at least according to the Act, at least once in 4 months. I don't think any public institution in Sri Lanka has this kind of accountability in the Act to the Parliament. As the next function, as I mentioned earlier, debt management function, which has now fully transferred to the Public Debt Management Office of the Minister of Finance. Coordination with the Minister of Finance on the public debt related matters will continue through the Public Debt Coordinating Committee that we also have representation there, ensuring a seamless transition. For the time being, Central Bank will continue to operate the scriptless securities settlement system and central deposit system for the government securities until government, Minister of Finance, develop new technology and develop a system. And also other important part is supervision of primary dealers that will remain under the purview of the Central Bank as a supervision and regulation of the financial institution. Primary dealers also will continue to be regulated and supervised by the Central Bank. Even under the new PDMO Act. Looking ahead, effective fiscal, monetary and financial sector coordination will remain essential as economic transition from recovery to an enhanced growth phase, while continuing to encounter global shocks and climate-related shocks. Such coordination is expected to foster a stable macroeconomic environment and improve business and investor confidence. Now, let me briefly highlight a few aspects relating to internal organization supporting and continued modernization efforts. So, Central Bank continue to evolve and modernize in our operations. Over the recent years, the Central Bank has advanced its human resource strategies, revamping project, which is called HRSRP, through leadership and technical competence frameworks, targeted leadership development programs, and strengthening foundational enablers such as job role definitions, manpower planning, and performance management. All these functions are being modernized under the new HR revamping project. Building on these achievements, Central Bank will progressively implement a comprehensive suite of HR policies from 2026 onwards. The ultimate expectation of this revamping is to create a highly competent, motivated, and agile workforce capable of meeting the evolving demands of central banking and the overall economic and financial landscape. In 2025, Central Bank further strengthened the risk management. That's the other important part for the Central Bank functioning, the risk management frameworks, by establishing the risk appetite framework and balance sheet risk assessment. Central Bank balance sheet risk assessment is the new framework to formalize risk governance. Starting in 2026, these frameworks will be expanded to include strategic, financial, and compliances, covering important risk areas, strategic risk areas. This expansion will be supported by clear risk ownership, enhanced oversight, and advanced analytics. We have a framework here, board risk oversight committee, and the financial sector and non-financial sector oversight committees, and also risk management department and other first layer, second layer, and third layer of defense. These initiatives aim to institutionalize strong governance, reinforce accountability, and foster a resilient risk culture throughout all operations of the central bank. In 2025, the central bank advances digital transfer. That's other important area in the technology adoption. Within the central bank advances digital transformation through strategic IT initiatives, including modernizing core systems, establishing a roadmap for centralized big data and data warehouse platform, and enhancing cybersecurity and resilience in line with international standards. Going forward, while continuously enhancing information security, Central Bank will also commence establishing the centralized data processing and analytical system, CDPAS, centralized data platform, fulfilling a foundational prerequisite for modern governance and operational intelligence. This will help the whole process of the central bank operations. With full implementation plan over several years, this will take number of years. We initiate in this year. It will bring the currently scattered information sources into a reliable repository. This foundation will be complemented by an open API framework, enabling secure, standardized data exchange with external stakeholders to promote transparency and innovation at minimum cost efficiency with open systems. So, in conclusion, let me briefly present some key points. After a prolonged period of unprecedented challenges, Sri Lanka enters the new year with broadly stabilized macroeconomic conditions. While the recovery has been notable, and in several respects faster than anticipated. Preserving these hard-earned gains will require a sustained commitment to prudent policymaking and continuation of economic reforms. Those were initiated in the recent past. The recent experience of Cyclone Ditwa served as a timely reminder of the critical importance of building and maintaining strong macroeconomic buffers. The period ahead calls for a decisive shift from recovery to resilience by strengthening policy credibility, reinforcing economic buffers, and enhancing the economic's capacity to absorb shocks. These efforts will be vital in unlocking higher, more inclusive, and durable growth and enabling the economy to progress to a greater heights without compromising stability. The stability is the foundation for growth. In this journey, the central bank will remain steadfast in fulfilling its mandate to maintain price stability and safeguard financial stability, while setting the platform for sustainable and inclusive economic growth. The policy agenda announced today outlines the central bank's commitments as we move forward on this journey. I'd like to reiterate that the policies outlined today, as I mentioned earlier also, would continue to be refined as appropriate depending on the changing circumstances, as economic conditions evolve and new priorities could emerge. On behalf of the Governing Board, the Monetary Policy Board, and all staff of the Central Bank, let me once again wish you a new year marked by resilience, stability, and growth. Thank you very much.
Thank you very much, sir, for that clear, insightful, and forward-looking statement, setting a clear course for the period ahead. And I'm sure that all of you will find the guidance outlined in the statement useful as you shape your plans for the year ahead. Ladies and gentlemen, the English version of the policy document outlining the central bank's policy agenda for 2026 and beyond is now available online on the central bank's website, www.cbsl.gov.lk, under the category of speeches. And for your convenience, a QR code is displayed on the screen behind me and also in the screens that you would see there, enabling instant access to the document. I must mention that Governor and the team have been working tirelessly and collaboratively right up to the early hours of this morning to finalize this comprehensive policy agenda, ensuring that it reflects the latest strategic priorities. Accordingly, the English version is being released at this time, and please be assured that the Sinhala and Tamil versions are being finalized with equal care and will be made available online shortly. With that, ladies and gentlemen, we have come to the conclusion of today's proceedings, and on behalf of the Central Bank of Sri Lanka, I extend our sincere appreciation for your presence and engagement this morning. We look forward to your continued support as we build on stability, strengthen resilience, and work collectively towards a future of sustained growth and shared prosperity. Before we officially conclude, I invite you to join us for refreshments in the adjoining lobby area, where you may continue conversations and, of course, network. Thank you very much once again, and I wish you all a productive, successful, and a prosperous year ahead. Thank you very much.